Kathy. All right, it's 3 o'clock and we have a quorum here in chambers with Glenn Morey, Mike Lane, and myself. Martha is currently attending remotely and plans to be here eventually in the flesh. Rich John is not going to be able to join us today, so we're going to go forward. And before we get to minutes approval, I just wanted to confirm what I had said in an email that I sent earlier to all the concerned parties. We're going to be changing our agenda up a little bit, we're moving Rick's report and Bill Talbot's resolutions relating to the TC3 budget up a little bit and moving Lisa down in the agenda so that will give Martha time to get here in person. So that said, we need motions to approve the BCP minutes from June 11th and the expanded budget committee meetings minutes from June 30th. So I would entertain a motion. Glenn moves, Mike seconds. I think we can deal with both of these simultaneously. Does anybody have any comments or questions about these minutes? If not, are we ready to vote? All right, now we can raise our hands, everybody. All right, that's 3 in favor. Martha can't vote yet, so that's unanimous, Kathy. Do we have any comments from the public today? No, we don't. All right. I will reserve my committee chair report because I think that that's all going to be lumped in with the report from the county administrator. And we will move directly to Rick Snyder.
Thank you.
Yeah.
I won't spend a lot of time. I'll pass it right on to our auditors, 3 of them that are here with us today. We're proud to present the 2020 financial report. And we have 3 of the team from Insero and Company. We have Leslie Spurgeon, Conrad White, Colleen Stannard. They all have worked in different capacities on this audit. And the drafts were attached to the agenda for today. I'm sure you've read every word, but if you have not, we're going to go over some of the highlights today. And next week, if we polish this up and finish this draft in time, we'll be able to present it to the entire legislature in a PowerPoint next week. That is our goal. And so with that, I'll turn it over to the folks from Insero. And should I introduce Leslie? Will you be kicking it off? Okay, you're muted, Leslie.
Sorry, I thought I was unmuted.
Thank you.
Hi, everyone. I am the engagement partner on the audit. Colleen Stannard is the manager, and Conrad, who did most of the work, is the audit supervisor. So Conrad's going to share his screen. If you started to. There we go. Now you would have gotten a bunch of several documents, a bunch. I'm going to work primarily off of the executive summary. We'll go back and forth with the letters and so forth. But first I want to say that this year was definitely different than last year. Last year we were in the thick of COVID. So this year we were able to do more on site, and everybody got through the COVID handicaps with not being able to be in the office and just having to adapt to so much remote work. So thankfully we're able to present this earlier than we did last year. So things went a lot better. My thanks to all of the Tompkins County staff, to Rick, Drew, and Joanne primarily, as well as the departments in getting us the information that we needed. It was a real team effort, and I really appreciate that. So I'm going to primarily work off the executive summary, and Conrad, if you can page down. This first page goes over all of our deliverables, basically. It starts out with the financial statements. We've given you an unmodified opinion on the financial statements. And this is the highest level of assurance that you can get. And it's basically saying that we believe that your financial statements are fairly presented in all material respects in accordance with generally accepted accounting pronouncements. Also in our report, because we audit you under government auditing standards, there's a report on internal control over financial reporting and compliance. So I'm pleased to say we had no material weaknesses or significant deficiencies, and no instances of non-compliance. We'll get to the management comment letter in a minute, but we didn't have any comments that we needed to report this year. So no findings when we looked at your controls over disbursements, receipts, payroll, and all the other items that we look at when we're doing the audit. So we have no findings basically in the audit. So I think you can feel very good about that, and kudos to all of your staff for that accomplishment. Now the single audit, this next item is, this is the compliance part of the audit, the compliance with federal program requirements. Every year we have to do a risk assessment of what federal programs we will test. This year we tested about 7 programs. The biggest ones were WIC and HEAP and the Child Care Development Block Grant, as well as some other smaller ones. And we had no findings with our compliance audit. As you can see there, you spent $36 million of federal money last year in 2020.
So that amount is actually up around $7.8 million from the prior year. And a large portion of that was actually due to your airport improvement projects. So that took up some $10 million more in your federal expenditures than you had last year. There were some decreases, but the big increase this year was your airport improvement projects.
Thank you, Conrad. And that program we didn't need to test because we tested it in prior year. So that was considered a low risk program. So we didn't test it this year. Now, one thing I will say with the financial statements in the single audit section is that we're still waiting for some information to verify the DSS numbers for the scheduled expenditures of federal awards. So, there are some things that could change in that schedule. So just so you know, I don't think it would be anything material, but that shouldn't affect the actual financial statements. It might affect some of the CEPA number, the scheduled expenditures and federal award numbers. So just to let you know about that. Any questions so far about the audit process? Okay. Hearing none, then we'll go to the letters. And Conrad, I'll ask you to actually go to the communication letter if you would, please. Do you make? Yeah, thank you. My eyes are not that great. So in this letter, it's the same letter that we give you every single year. Some things change, but mostly it's very similar from year to year. The first item there, the aspects of accounting practices. We had one new accounting pronouncement that was implemented this year, and that had to do with fiduciary activities. It basically changed what gets reported as a fiduciary activity. So you have your governmental funds, and then you have your agency funds. Traditionally, that's what it used to be. And in the agency fund were monies that we didn't really think belonged to the government itself. Well, this new standard takes a fresh look at what should be considered a fiduciary activity. And the biggest part of that was your payroll liabilities. In prior years, that used to be reported in a fiduciary activity or the agency fund. With this new statement, those liabilities need to be reported now in the fund that generated the payroll. That's really the biggest change. So if you are comparing the agency fund from year to year, it will look a little different this year because of those changes. Accounting estimates. There are accounting estimates in these financial statements. They consist of depreciation expense, which is based on the useful life of fixed assets. So that's an estimate as far as how long each asset will what you think the useful life will be. Other post-employment benefits and pension obligations. Again, other post-employment benefits are your retiree health insurance and your proportionate share of the pension liability. It's based on actuarial studies, things like, how long somebody's going to live, health care trend rates, that sort of thing. Also, there are footnotes in the financial statements, and the most sensitive ones, or ones that are the most material, are the ones that are related to capital assets, the pension obligations, debt, retiree health insurance, and fund balance, and that lists the notes where you can find that information. I'm pleased to say that we encountered no difficulties in performing the audit. There were no misstatements that we need to communicate to you other than those that we consider to be trivial. There were no disagreements with management, I'm pleased to say. Management representations, this is just informing you that by the time we are finished with the audit and it's finalized, we'll have gotten a letter signed by management that basically tells us that we have all the information that we needed to render an opinion on the financial statements. There aren't any contingent liabilities or anything that would need to be disclosed that we haven't disclosed, or anything that would affect our opinion. There were no consultations with other accountants. That's kind of like opinion shopping. If you didn't like our opinion, you'd go to another accountant. So there wasn't anything like that. And as far as other matters, this section is just talking to about our responsibility to the required supplementary information, which is management's discussion and analysis, budgetary comparison schedule, and some of the required supplementary information on OPEB and pension, as well as our responsibility for other information, such as the combining financial statements for non-major funds that are in the financial statements. So that is the communication letter. And now, Conrad, if you could go to the comment letter and make that a little bigger, thank you. And as you can see, all we have here are discussion items talking about new accounting pronouncements that will be implemented in the future. You want to go down a little bit, Conrad, please? The really significant one is the one on leases, statement number 87. And what 87 does is takes operating leases that traditionally we've only reported the expense for the year, and then we've had a footnote disclosure about upcoming lease payments that you're going to be making. But what this does is that for any material leases, and I'm not talking about like little copier leases because they're just not material to the county's financial statement, but significant leases, we need to now record an asset, like a right to use asset, and then a corresponding liability. So that'll be the big change with leases. And then these other ones really don't have much of a change if they're really indeed even applicable to you. So that's all we had in the management comment letter. So like I said, no findings that we needed to communicate. So a very good audit. So before I turn it over to Conrad to go over the numbers, do you have any other questions for me about the letters or again, anything dealing with the audit process? All right, then Conrad, I'll.
I got a question. Thanks. for everything so far. I just wondered, when we're talking about leases, are we talking about leases that the county leases to somebody, or are they leases where we are renting from somebody?
Both, actually.
Both?
So, yes. So if you're the lessor, you need to capitalize that lease, and if you're the lessee, you need to capitalize it.
Okay, thank you.
Yep.
Are there any other questions? Okay, so I'll give you some overview on the numbers within the different funds. So I will also be speaking from the executive summary itself. Now, these numbers are on the fund basis. These do not really take into consideration the numbers that you will see in the big booklet, which have to do with the government-wide statements. I will speak a little briefly about that at the end, but for now, we shall start with your general fund. So looking at your general fund, overall, from the prior year to the current year, we've had an increase of about $4.2 million in your total assets for 2020. A lot of that has to do with this increase right here, which is about an $8.3 million increase. And a lot of that receivable is coming from your DSS, which is about $3.9 million, as well as $3.5 million in amounts from the state, which may have been delayed due to COVID reasons. As we go lower, we can see that on the liability side, there was an actual increase in your liabilities of about $1.1 million. The major part of that $1.1 million comes from your accounts payables and accruals, which were up about $3.2 million. A large part of that increase speaks to what Leslie spoke to you about GASB 84. We moved some of the liabilities that would have shown up in the old TA fund over to the general fund, and we moved about $2.9 million of those liabilities over to the general fund. There were some amounts that we also moved over to your CT fund or your airport, as you know it better. But that's why there's such an increase in your AP and accrued liabilities for the current year. As we take a look at your fund balance accounts, your non-spendable of 4.6 is actually equal to your prepaid expenses up here. And the majority of that is actually due to what you are prepaid for your ERS expense at year end. The restricted is down from your prior year, and because there was no room tax for the current year that was restricted. So that amount was entirely removed. And then in your assigned fund balance, it was up slightly. And the difference was that I believe was the RAA fund, which I believe, or correct me if I'm wrong, is monies that are set aside for when I'm sorry, I can't think of the words off the top of my head.
The union contracts.
Yes.
For future negotiations on future settlements, so that we have some money set aside for potential labor negotiations in the near future.
And then, thank you, Rick. And then the last amount is this $4.48 million, which is your unassigned, which is all the rest of your fund balance net of these three amounts. And as you can see, there was an increase in that over the prior year as well. Not as much as the increase as we saw from 2018 to 2019, which was about $5 million, but still just shy of about $2 million in an increase in your unassigned fund balance. Overall, your total fund balance did increase about a little over $3 million from the prior year. Now, some of the reasons for these increases for the increase in your fund balance in your general fund has to do with what you were able to do with your revenues and expenditures. We all know that it was a tough year But even though your revenues were down this year, there were some cost cutting measures on behalf of the departments and as well as Rick Snyder and with the help of the legislature in cutting your expenditures down $13 million over the prior year. Unfortunately, in the same breath, your revenues did also decrease by some $15.9 million. A large portion of that had to do with sales tax amounts that could not be received. So if you look here, there was $62 million in non-property tax items where sales tax lives, compared to only $55 million in the current year. Also, in your state sources, you were down about $10.3 million. You had some casino licensing decreases in revenue, as well as some social services admin, as well as mental health administration. On the other side, like I said, the expenditures did decrease some $13.2 million. A lot of that was in this economic assistance and opportunities line item, which also houses your social services expenditures. We also saw about a $2 million, a little over $2 million decrease, 2.5 in your transportation, and that has to do with your bus operations, which we saw a decrease of this year. So overall, there was an excess of your revenues over your expenditures of $3.1 million. Any questions on the general fund? So as I'm going forward, we'll talk about your capital projects. So the county itself has multiple capital project sub-funds, which we have combined into this one area for our report purposes. So as we look, your overall assets did decrease by $1.5 million. A lot of that had to do with your due from other funds. A lot of what was in this $4.9 million in last year was actually the HQ fund, which is one of your capital funds, was due amounts from other capital sub-funds and were left in there. And we did not see as much of that in the current year, which means that these were paid off in a timely fashion. What we did see was an increase of about from $880,000 to $2.9 million in receivables. A lot of that has to do with your transportation or your HT fund, which deals primarily with your airport. And what we saw there was a $1.2 million receivable, mainly due to CARES for your airport improvement program. On the other side, with the liabilities, we did see that there was a decrease in your overall accounts payables and accruals from the prior year of about $4.9 million. A lot of that had to do with the timing of how certain contractors were paid throughout the year. And a lot of it was done prior to year end. As we go down, we see your bond anticipation notes payable. These are your short-term debt instruments. There was an increase from the prior year. I believe in the prior year, we only had 2 bands. In the current year, there were 3 bands for across all the capital funds. Your due to other funds did decrease tremendously. As we noted here, some of the money that was due to the HQ was due to the HQ in here, was also living here. And the other portion of what this $9.3 million is made up of is the amounts that were actually due to your general fund from your HT fund for expenditures covered through that fund. Looking down at your restricted fund balance, there was a decrease this year due to how we, in certain sub-funds of your H fund, we did notice that there was a deficit, and we were not able to restrict amounts in funds that have a deficit. So unfortunately, there was a large decrease in your restricted fund balance from about $1.7 million down to $5,000. Committed represents certain sub-funds which the amounts have been committed to, as also with the assigned. And then overall, your unassigned fund balance did decrease from $13.1 million down to $5.7 million. as we look at the other side, we can look at the revenues and the expenditures within the,
There's a question here.
yes.
Couple of questions.
Mike Lane again, can you explain why you think the restricted fund balance dropped so?
So what it had to do with within certain funds, there was an excess of expenditures over your revenues, which actually caused a deficit fund balance. That can also be due to where the bond anticipation notes payables are housed. So that we should see that reverse itself in the current year as these bands are converted into long-term debt.
Hi, my baby.
I guess I'm not understanding it. I understand that where you can get a deficit, one's higher than the other, but what's driving that?
It could be unspent debt proceeds at the end of 2019 for the airport improvement project ban. Does that make sense? That you hadn't had time to spend it yet at December 31st, 2019. So it was restricted, but it was spent in 2020.
I
when
see.
the project was being done.
All right, that makes sense.
So I have another question in regards to the bond anticipation notes payable. Is the difference between 2019 and 2020, is that the $8 million that was bound, that we bonded for the airport?
Yeah, we went by the end of the year of 2020, we had $13 million of bans just for the airport. So we went from about $11 million in 2019 up to 18.2 million. 13 million of that was just for the airport because we had to do $3 million extra in the middle of the year in July to bring that up to 13 million. The other 5 million was for other assorted bans, mostly for road and bridge projects, like we normally do throughout the year. And that's why you see the increase in bond anticipation notes.
So is there a reason why we didn't use any of our CARES funding to offset some of the bonding?
We did use CARES funding. A lot of that was in the operation of the airport, and that was totally figured out, negotiated, and worked on by airport management and their engineers. So we did have a significant amount of funding to the airport, but not in this particular capital project. That was in the airport operations fund.
Okay, thank you.
Okay, I'm sorry, go ahead.
Oh, all right. So we'll now take a look at the revenues and the expenses for your capital projects funds. Your revenues did increase $8.1 million. A lot of that has to do with your federal sources that you did obtain for your capital projects funds, which also, as I mentioned, showed why there was such an increase in your overall CFO amounts for 2020. In addition to that, there was a slight increase in the state sources as well of about $400,000. On the other side, your total expenditures did decrease over the prior year a lot. In total, those did decrease by about $18.5 million. As we can see, a lot of it was in this transportation line item that had to do with the airport as well. There were some other transportation expenses in the prior year that were running through this, but weren't really done with federal funds. We also did see an increase in your public safety expenses over the prior year. Going down, we also did have some transfers in and transfers out. Both we saw that transfers in were significantly less than the prior year, but there were some transfers out to, I believe, the general fund that were significantly higher than the prior year. The last part of the other financing sources and uses was $1.8 million, which you did bond for in the current year through your capital projects funds.
So may I ask, when you say that our expenditures for capital projects decreased, is that really a decrease, or is that simply that we've had to delay things till after the pandemic is over?
Most of it is, this is Rick, most of it is not really pandemic related. As you know, the capital projects, especially here at the airport, span a 3-year period. So when you go to that transportation line item, you have $9 million in 2018, $33 million in 2019. 2020 was almost $13 million. Most of that was for the airport. Some of that was for roads and bridges. So it all gets lumped into that one line. So over a 3-year period, you see ups and downs in the expenditures, and your capital project expenditures can be quite variable from year to year. But it's not because we really put off projects. We may have put off some projects like the initial start date, such as that we're getting back in gear right now with the ARPA funding and thinking about lifting off some capital projects. But we really didn't postpone anything that we were, I'd say, like 25% into. You know, we just kept on going, and like I said, the expenditures on a lot of capital projects tend to span more than just 1 year. They tend to span sometimes a 2 or 3, even 4-year period if it's a large building.
Okay, thanks, Rick. I just wanted to be sure we weren't looking at an unexpected deferred maintenance coming due.
No, nothing wasn't done that we didn't know about. I mean, how can I say it? The best refresher you'll be getting in the, actually, you've already started with the capital planning document. You're already well into that with Lisa Holmes, and you can see that it's pretty much the same as it looked last year. Some things got moved out a year, but basically it's pretty much intact, and it looks a whole lot like previous 5-year plans. And you'll be getting a lot more of that capital planning budget over the next 2, 3, 4 weeks, especially as you're pushing us because of the need to figure out what we're going to be doing with ARPA funds. So we're actually a little bit ahead of schedule in our capital planning this year.
Oh, I thought you were pushing us, but okay.
No.
Okay, thanks.
Any other questions on the capital projects? Okay. So next we'll move forward to your debt service fund. Overall in your debt service fund, there was a slight increase in total assets over the prior year. So about $500,000. A large portion of that is your restricted cash, where there was an increase of about $600,000 over the prior year. Your securities and mortgages, which is a receivable from various entities throughout Tompkins County, did decrease as those were paid back. And overall, we did see a restricted fund balance of $2.9 million versus $2.2 million in the prior year. On the other side, your revenues did decrease from the prior year. But the big takeaway from this is your expenditures. A lot of your expenditures are tied up within the $6.4 million, which is debt service, which is your payment of both the principal and interest on your bonds, on vans, and maybe some of your and the items like that. So that takes up about $6.4 million. In the prior year, it was some $6.5 million. So we did see a slight decrease over that. Overall, the excess of revenues due to an interfund transfer in of $6.3 million and your premium obligations of $179,000 brought you to an excess of revenues of about $700,000 for this year. Your special revenue funds. So within your special revenue funds are funds for the county, such as your CD fund, which is your special grant fund, your CL fund, which is your refuse and garbage, your CT, which is your airport, your road fund, your road machinery fund, and some of those other funds that I have not talked about already. One thing that's also included in here, but you do not have maybe a day-to-day impact on, is the task fund. We also do include tasks when it comes to our special revenue funds for the county, as it is a component unit of the county itself. So overall, we did see an increase in your cash from the prior year in your special revenue funds of about $1.5 million. As well as that, we did see an increase in your receivables of about $1.1 million. And that did lend to the overall total assets increasing from $7.7 million of about $2.4 million increase. On the other side, we did also see an increase in your total liabilities of $1.4 million. So a lot of that liability had to do with $653,000 increase in your accounts payable and accruals. And as I said earlier, part of that increase has to do with us moving amounts from the agency fund over to the airport fund in the current year. The other increase that we had was within the due to other funds of $925,000. I believe some of those amounts were due to the general fund as well. As we look forward, we do have some restricted amounts within these fund balances of about $1.2 million, so a decrease over the prior year. And then everything shows up as unassigned as the catch-all in your general fund. In your special revenue funds, it actually shows up as assigned. So this is the residual fund balance of all your special revenue funds, about $5.6 million.
So Conrad, the restricted is primarily the special grant fund, correct?
Yes, it is. $1.2 million is special. Most of that is in the special grant fund, yes. Any questions?
I just say that's restricted because it's funded with grant funds that are restricted. That's the purpose.
So as we look at the revenues and expenditures, we did see that there was a decrease in overall revenues of the special grant funds of about $576,000. The biggest decreases that we did see were in your departmental income, and we anticipated some decreases there due to COVID related reasons, but we did see an increase in federal sources of about $1.4 million. As we go forward to your expenditures, we also did see a decrease in that, but not as much. But we saw about $273,000 decrease in your total expenditures, which most of those come in within your home and community services line item. Overall, for all your special revenue funds together, we did see an excess of your revenues and the other financing sources over your expenditures and uses of about $1 million. Now, this last slide really takes what we do at the government-wide net decision level. So before I show you this, I will give you an idea of what your government-wide statements then look like. Here we have which is the big booklet that you received. This is all the governmental activities for the entire county, with the addition of things such as your capital assets, which are more long-term, as well as the pensions, which is your GASB 68 ERS amounts, and your other post-employment benefits, which is your OPEB amounts, other post-employment benefits. We include these as well as the long-term obligations due within 1 year, which really are your outstanding bond liabilities for the current year, in addition to a couple others. So overall, for the year 2020, we see that there was a total net position for the county itself of some 129,808. However, the unrestricted portion of this was $39 million, but that was a deficit. So what we would like to show the legislature is that within this $129 million and this $39 million deficit also lives the GASB 68 net pension liability, and as well as the deferred inflows and outflows, which make up about $14 million in that liability. And the OPEB liability, your other post-employment benefits liability, and the related deferred inflows and outflows, that liability for the year showed up as about $89 million. So without those two items, you would have had an unrestricted net position of $64 million. The biggest increase we did see this year from the prior year was this net pension liability. It increased as I was reading into the state's plan. We did see that in the prior year, the state showed a net investment income of about $7 million. In the current year, we actually saw a net investment loss of about $9 million. So that really lent to why there was such a big liability compared to the prior year in the net pension liabilities. So it depends on how the investments at the state level will drive. That should be one of the factors in driving what the liability will be in 2021. Sorry.
And that OPEB liability, which is your retiree health insurance, I mean, that will continue to increase, as you can see there. But you're not allowed to fund that in New York State, and I don't think anybody would really want to fund that $86 million or $89 million liability. So therefore, your net position, your unrestricted net position, will continue to be deficit. And you're not alone. Every municipality in New York State is in the same boat, as well as all over the country, although some states do allow municipalities to fund that. Again, I don't think there are very many that would want to do that. So that's just a little explanation of how you got to an unrestricted deficit on the government-wide level. It's mainly those two items, your pension and OPEB, that are driving that.
Are there any questions?
Yep.
Yes, Mike Lane again. On what you were just saying there with the pension liability, you were saying most counties aren't trying to account for that, or not account for it, but try to reduce it. Should we be trying to reduce it?
Well, the pension liability, you really have no power over, because that's done at the retirement system level. The OPEB, the retiree health insurance, you can change that as you change your policies or your contracts, as far as what you'll cover and how much the employee costs the county. That's the only way that you could really have control over that. I mean, you can do do some cost saving measures to try to keep that health insurance expense down. But, that liability is taking your workforce in place, as well as all your retirees, and projecting, doing a net present value of all those benefits that you're going to be paying in the future, as well as the ones that you're paying now. So hopefully I answered your question. So basically what it comes down to is managing that retiree healthcare cost. And to that extent, you can reduce that liability.
They're making us account for it as a liability.
Pardon me?
Should we be building up a reserve to compensate for that liability?
That kind of goes against, Leslie was stalling there, but that kind of goes against the rule that you're not allowed to fund it. Because if you're building a reserve, in fact, you are funding it.
Well, the thing is, you can if you do build a reserve, it can't be put in a private purpose trust in New York. The only way that you can reduce that liability by setting money aside, if you don't understand what I'm saying. You can increase your fund balance by setting up a reserve that will offset that deficit. But the only way you can really reduce the liability is by putting those monies aside in a private purpose trust, which in New York State, you are not legally allowed to do. There have been various attempts by different people to allow, early on, when GASB 45, the precursor to 75 came out, I think the NICE Act was trying to do that, trying to have New York State pass legislation that would allow you to do that. But I think as time went on, people realized they don't really want to take money and put it in a private purpose trust in order to reduce that liability. You know, it looks bad in your statements to have that deficit. I mean, when you see it, it's like, yeah, that's a big number. But in effect, if you look at other governments in the state, which you're being measured against, they're in the same position that you are. So, I mean, you're paying for those benefits on a pay-as-you-go basis. So every year you're budgeting for that. So unless you felt like you weren't not going to be able to have the funds available to pay that liability, you might want to set some funds aside. But so long as you're able to budget that on a pay-as-you-go basis sufficiently, I'm not sure I see the reason to set money aside just for that.
And Mike, I'd add that the most effective way to create some dynamics so that cost goes down or that it doesn't grow as fast are the two samplings that we've done here at our county that really aren't showing up yet in our GASB valuation because they're always a couple years behind. And one of those things was when county administration came out with putting all new employees on the
Platinum plan.
instead of the indemnity type and PPO plans. That happened in 2015. So we're starting to see that drive the costs down. You can see that at the health insurance consortium, how our costs are being kept down because of more and more people being on that platinum plan. The other thing that was done that hasn't showed up until this next GASB report is that action that you took that forces people that retire into that Medicare type plan that they can't retain their old PPO plan. They have to go with a Medicare type supplement plan for future retirees once they hit 65. And that's so new yet. That only happened like a year ago. And that won't, those new plan restrictions and the new covenants haven't shown up until we do our next GASB valuation, which we just started a couple weeks ago.
Can I interject here? I think we're kind of getting off track in terms of what we need to know in order to accept this audit report.
Okay.
And I know that Kathy's got another meeting in here at 5:30 and we still have a long way to go and it's 10 to 4.
I was done. I just wanted to tell you those were some of the views that administration has taken over the last couple of years to try to cut those costs going forward with OPEB. That's really all I wanted to say.
Right, and I think probably we're going to be discussing the implications of these audit reports for our future planning for a while now, but if we could please just move on to the resolution to accept the audit report, I'm sure Kathy would be very grateful. So is there anything else that we want to ask our auditors, or can we move on to the resolution? All right. So I want to thank our intrepid auditors, and particularly my favorite auditor in the whole world, Colleen Stannard, who I didn't hear much from, but hi, Colleen. And we have a resolution, document ID 10199, acceptance of audited financial report for the fiscal year ended December 31st, 2020. And I would gladly entertain a motion to thank you, Glenn. And a second, please, Martha. Are we ready to vote? Looks like we are. All in favor, raise your hand. All right, that's 4 out of 4 in favor. That's unanimous. Thank you, auditors, and thank you, Rick.
Thank you so much.
Thank you.
All right, so let's now move on to Mr. Talbot. We can stop sharing this. Thank you. Okay, Bill, you're on.
Okay, thanks so much. You've got 2 resolutions in front of you. One is the workforce development, and the second is the 21-22 budget. So let me just.
Bill, can I ask you a quick question? The last time we really talked about this, we were going to hold off on funding the first year of the pilot project in order to give Cortland County a chance to decide what it's doing. Has that situation changed?
It has changed.
Okay, good. I'm sure you'll explain it to us.
Okay, so let me start with the budget, and then we'll jump to the workforce development.
Okay.
So you have a 2-pager, which gives you the highlights, the executive summary of what we're proposing and where we are. If you'd like, I can run through very quickly just a 5-minute summary. We can just go with that, and we can work right off of questions. So it's totally up to you.
Well, I think it would be good just to have an overview so we know exactly what we're voting on. And then I don't know what HEERF funds are.
Oh, that's just the HERF is on the education side. They're the organization that the federal funds are migrating through. The federal funds come through. So whether it's CARES, CRSA, or ARP, they're distributed through HERF. And so the education department has defined the rules in which we can use those funds. And so CRSA and ARP, which we just recently received, are basically being treated similarly, and they've actually put those 2 groups of funds together.
Okay, thank you.
All right, so if we just run through just really quick, since COVID, which started in spring of 2020, the college is focused on reducing costs and conserving cash. SUNY released the Community College 2019-20 operating cost per FTE. TC3 had the lowest of the 31 colleges, $10,839 per FTE. That's $2,300 less than the average FTEs across the 31 community colleges. And just to note that if we were to spend as much as the average, we would have spent $6.3 million more as a college. So it's pretty material, the differences between what we're doing versus the rest of the colleges. This year's enrollment losses at TC3 were in line with the other community colleges, about 12.2%. However, recognizing that 50% of our FTEs are coming from concurrent, which doesn't net us any tuition or fee revenue. Concurrent remained constant through this pandemic. And so all the losses that we incurred were in core, which is about 23% reduction or 400 full-time equivalents. And so that's pretty significant. And of that, the 50% were from out of county which understand we get county chargebacks from also. So the losses on a sponsor county FTE is about $5,700, while the out-of-county losses are $9,500. So this equates to about a $3 million loss in tuition revenue last year. So this year, the real focus around our business plan and budgeting is to capture our FTEs both in the county and out of counties. So we've come up with 5 initiatives, which is outlined in the 2-pager. The first 3 really is focused around increasing enrollments over the next 3 years, with an objective of not losing any further FTEs this year coming up. Some of our colleagues are already reporting anywhere from a 5 to 10% reduction in their FTEs this year. And so the intent is to maintain our FTEs this year, grow our FTEs by 18% or 237 FTEs next year, the following year, 22-23, and 15% in 23-24, another 234. So that gives you some perspective of the focus, and that we're looking at this as a 3-year plan. As we return to if we look at the costs associated with all this, we've got costs that we've saved, but those costs are going to come back. A great example is the 1 month of
Premium holiday, that one?
what's that?
The premium holiday?
Yeah.
That was nice, wasn't it?
It was nice. So for us, that was almost $400,000. And then there's things like copies, there's support services, there's the student workers. All those things, we did not incur costs when we were totally remote. So all those costs come back. And then, of course, we're investing in certain positions and in certain contractuals in order to drive the revenues back up, drive the enrollments back up. So from that perspective, we're looking at a $4.8 million imbalance between our expenses and our revenue for 21-22. The sponsoring counties are contributing a couple $100,000 support for the workforce development. So that's very helpful. The feds are providing the other difference. So between the SRSA and the ARP, we get 6.9 million, and we'll be using 4.6 million of that for the lost revenues that we're going to see in this next year. As far as if we look at some statistics, okay, from SUNY, and we look at the sponsoring counties contributions, your contribution between Cortland and Tompkins was 4.8% versus the average of the other counties at 22%. And 21-22, this rate is actually lowered to 13.6%, and that's predominantly because we're getting monies from HERF, from the feds. And then if I just make a note that if we were to have increased the sponsorship county contributions, that would require almost another $3 million a year from the 2 groups. It'd be a 60% increase. Lastly, I just mentioned that from a fund balance standpoint, we are migrating or moving towards trying to improve the stability of the college. And so we believe that if we were to retain 3 months of wages and benefits, that would be financially helpful to the college. So we are expecting at the end of this year to be able to put back about $800,000, which would bring us to about 1.6 million. And so over the future years, we'll try to build that up to a $6 million reserve for fund balance. So that kind of gives you some perspective. What's very different about this budget year than others is not just COVID, but this was more of a business planning effort as opposed to a budgeting effort. So the budget was driven out of the business planning. And then 2 is we looked at over the next 3 years as opposed to just 1 year in advance. And I'll stop there and ask for any questions.
Thanks, Bill. Does anybody have any questions? Because I sure do. Okay, seeing none. Okay, so this year you've got multi-millions from federal funding streams to shore you up and keep our contributions as a county fairly level. My concern is your 3-year business plan depends on a fairly substantial increase in enrollment next year. And is even that 18%, assuming it's attained, going to be enough to prevent you from having to come back next year and ask for quite a lot more from the sponsoring counties?
Okay, so the plan is for this next year is there's no increase. So we just do not lose any additional FTEs. Year 2, we increase core by 18%. And in year 3, we increase core by 15%. So
but my question is, if you do increase core by 18% for 22-23, I still wanted to know if, even under that scenario, how much are you going to need from Cortland and Tompkins County?
we should not need any for year 2 because we'll have $2 million put aside from HERF that would cover the difference, the outstanding difference in the revenue for year 2. And then year 3, with the increase, the additional 15%, we should be able to self-sustain ourselves financially.
Okay.
It's the same issue that all the colleges are having at this point.
Right.
It's a big, there's no question there's risk associated with this.
Right. Okay, Martha has a question and then Mike has a question.
Hi, Bill. I'm looking at the 2-pager and I read it already. I've already read it, but I can't find it. You said the HERF income is $6 million.
The HERF million right now between CIRSA and ARP is 6.9 million.
6.9?
Mm-hmm.
Okay, and this coming year, you're planning to use 4.6. That would
Correct.
That what I'm, right?
Yep, that's correct.
Okay, and so the balance goes into fund balance?
Well, yeah, we're actually going to, I'm proposing that we actually create a new type of fund balance for these excess HERF funds, and we keep that separate from the college fund balance. I think it makes a little bit more sense when we're talking to the unions and negotiating, is that they don't see that the fund balance just jumps up hugely, millions and millions of dollars, but rather there's money that we're drawing down this year that we're putting away that we'll be needing in 2 years from now in order to balance the budget. So I am trying to keep a physical, keep that physically separated.
All right, thank you very much.
Mike?
Well, I've said this before, but, we certainly appreciate the college not asking for an increase from the sponsors, but I don't know if that's really doing ourselves a favor if we know your costs are going to go up for example, your labor contracts and other things. It seems to me that the 2 counties ought to be increasing their contribution. And we've gone through this over the years many times, talking about whether we can add 1% or 2 or 3. I guess it's not going to happen this year, but I certainly would like to see next year that there be a request to begin moving it up. Otherwise, you have too large a jump when the grant funds are gone.
I think that's fair, Mike. There's nothing that prevents us from coming and asking for that out of cycle. We're obviously very trying to be good partners and trying to make sure that we do the best we can to maintain this. There's obviously arguments that could be built around that it'd be wonderful for us to see an increase in the percentage of contribution from the 2 counties. And there's nothing preventing us from having a separate meeting with the 2 counties to talk through that. That can happen in September. It could happen in October. There's nothing preventing us from carrying on those conversations. What I did not want to do, and it is challenging to get everybody in sync between the two groups, is I didn't want to hold us back from moving forward with a business plan that really puts a lot of resources on trying to change the way we do things, both the way we market, in the way we enroll students, the way we retain students, and make sure that the funds that we do have access to, that in fact, those are going towards a purpose to future self-sustain. But you're right, there is a huge amount of risk around, will the market come back? There's lots of studies across from the national standpoint that says that, the northern community colleges are losing enrollments to the southern community colleges, that people are migrating further south. So we are trying to be creative and address that in a very proactive way. But we would never turn away the two legislators coming back and saying that they would like to contribute more to the college.
I'm sure you wouldn't.
Well, I think this year, I would like to see us, between the resolution that's on before us today and the budget process for the next few months, I would like to see us at least give TC3 the comfort of knowing that we will be funding our piece of their workforce development project. And then next year, I guess, if it looks like we're not going to hit the 18%, or if there are additional needs, we can just bear that in the back of our minds that we may be facing an increase in next year's budget process. Henry, did you have something?
Yes. Bill, I was wondering what the admissions numbers are so far. Are you off track or on track?
Say one more time, Henry, you broke up.
What are the admissions numbers so far for the next semester?
Okay, so we're running about 6% behind, but there's a huge initiative right now to market, both in New York City, in our local area, in the donut, what they call the donut counties of those, which line up right next to Tompkins and Cortland. And then we also have a huge effort right now where we're putting new processes and training in place to better convert those leads that we're getting. So we do believe that we've got the plans in place to make a change and get that back up to last year's enrollments in the next 6 to 8 weeks.
Thank you.
Okay, Martha?
Regarding Mike's point about trying to avoid big jumps and have a more steady level of increase. So last year, what did we do? Did we do 5%? What did we do for the year we're in? What was the increase?
There was no increase.
I didn't think there was an increase.
No increase.
It was 2 years ago. I know what you're thinking.
So
No, it was more than, it was 3 years ago that there was an increase. I don't recall what the percent was. And part of the challenge was, as everybody understands, is Cortland was having some real difficulties, and you can't contribute if they're not contributing. They actually seem to be in place right now, and seem to be open to this type of funding, especially when it's tied to something very specific, like what we've done. And we could do more of that as a means by which to fund projects out of cycle. But
okay, I'm actually going to kind of underscore what Mike said, and it's hard for us to propose something that you haven't asked for. So if it's been that many years, I understand, like a year ago, nobody was envisioning we could come up with any extra money. We were just trying to hold tight. But if it's been 3 years since the last request and the last increase, I really worry about going another year, and especially there are just a lot of hopes built into this. So I guess I don't know whether that's something when you present to the legislature, maybe revise your request. I don't know how you want to do that. it also gets awkward to try to do off-cycle, out of the normal cycle requests. That's actually a little harder to do sort of psychologically. So there's just a word there. Let me ask you about international students. That's usually in the past been really great income for you. Are you seeing that come back anytime soon, those students?
The Disney program, the answer is no. The traditional international students, which we didn't get a large number just coming on their own, the answer is no. However, the global program that we've got with the DR, Dominican Republic, they are attending right now remotely this summer, and then will come physically for the fall semester. So the answer to the question is yes, it is starting to come back as long as everything continues, from a pandemic standpoint and opening up.
Okay. All right. So I'll just let you think about maybe rethinking the 0% increase, if that's something you could.
I brought it up, but I can understand where it'd be awkward with trying to bring Cortland in at this point.
Okay.
Yeah, I think.
I think we've got to really aim for next year.
Okay.
Yeah, and I think that as we move forward with our financial planning for the county, we need to bear in mind that there is altogether a big possibility that we're going to be asked to make a significantly increased contribution to TC3. I think we'll leave it there for now. And I guess we will move on to the resolutions. The first one being ID number 10175, adoption of the 2021-2022 operating budget, Tompkins Cortland Community College. And I would entertain a motion to, thank you, Glenn, and a second, Mike. Okay, are we ready to vote on this? Bearing in mind that next year may be different. All in favor? And that's 4 out of 4, unanimous. Thank you, that passes. And then we also have the resolution, let's see, in your packet. Oh.
I think that was sent out.
Separately by email.
Oh, okay.
The Workforce and Career Development Pilot Program.
Right. Is this the same wording that, because the copy I have doesn't have the document ID number on it. We had it on last month's.
Packet page 49, I have it in the packet. I don't know if the wording's changed.
No, I don't think it has. I think it's the same document. So yeah,
Okay.
that's document ID 10176. Thanks, Martha. That's on page 49 of your packet. And I would entertain a motion to get that on the floor. Glenn, second by Mike. Any discussion? Mike?
Simply, I think this is a well thought out proposal. It was done the right way, inviting both county legislator groups to come and talk and listen to your presentation. You seem to have good partnership with the workforce people in both counties, and I think we should move ahead with it.
I agree wholeheartedly.
By the way, the update there is that we did meet with some additional legislators that couldn't make that first meeting that we had with both groups, and they unanimously also agreed to support. And so I will be at their finance committee meeting tomorrow at 10 o'clock to, again, pass both these resolutions through Cortland.
That's great. And I hope this program is overwhelmingly successful because I think it's something we need. Does anybody have anything else? All right, all ready to vote? All in favor? Again, that's unanimous. I have such an agreeable group today so far. Okay, and then, thank you, Bill. I think that's everything you need from us.
All right, well, thank you very much.
Let us know how it goes tomorrow.
Will do.
Okay.
Okay.
Enjoy the shore.
Thank you. Bye-bye.
And then we have one more resolution, appropriation from contingent fund, terminal pay, county administration. And Lisa, you might want to speak to this.
Sorry, I don't have it up.
Here, you can use it.
Computer. Oh, so this is simply the terminal pay for Jason having left and for 2 other positions that ended at the end of 2020 for whom we haven't retrieved the reimbursement for the terminal pay.
Okay. Would somebody like to move that, please? Glenn moves it. Do I need a second? Martha seconds. Any discussion? This seems like a fairly routine ministerial resolution. So if we're ready to vote, all in favor? That's unanimous. Thank you. Okay. So question. Henry, can you report really quickly on workforce diversity and inclusion? Because I don't want you to get left out.
The WDIC met at the end of June. We thank everybody. This was a successful Juneteenth celebration. We later met to go over Juneteenth stuff. We also engaged y'all did a presentation on the county demographics. We're going to follow up with Ruby about that. And we had a values discussion from Amy Hendricks about the values, and we're going to follow up with that to basically give examples how the values, what specific county actions support the values. And that's about it.
Okay, any questions for Henry? Okay, Henry, thank you for your update, and we can move on. Now we've got a report coming from Ruby and also from Lisa. Which one of you 2 lovely ladies would like to go first?
I'd be happy to defer to Ruby. I think my items are probably going to take a little longer.
Okay, let's do that then. You're on, Ruby.
All right, thank you, Lisa. Okay, I just want to give a brief update of the searches and where we are, starting with the search for the airport director. We are ready to go, but there was discussion regarding
Yeah, I don't think that should be discussed.
the update.
Aye.
Okay,
Been any kind of announcement?
what was that? I did hear you, Mike.
I don't believe there's been any kind of an announcement of a vacancy yet.
Well, we have an agreement as of September. We were doing an
I'd
anticipated.
like to
posting.
ask for that to go into executive session if we're
I
going to
would
go on.
second
with it.
that.
Okay.
So do I do county admin first and then we can save that for executive session?
Yeah, I guess that's a good solution, Ruby. I didn't realize this was going to be so controversial.
Okay,
I thought there was generally an announcement. Nope. All right then.
okay. So as far as county administrator, we've contacted the firm and basically we've settled on Pinnacle from Albany. So we're waiting for the information regarding the benefits package so that we can do the contract and get that started and the posting's done. We've updated the job description. And there are just questions about the salary, the relocation allowance and the French packet. So I'm not sure if you want to do that in executive session as well, or I can tell you what we've found.
No, Martha, why are you looking so?
Isn't this something we discuss? Did I miss a meeting?
I think that she's saying we'll discuss it because.
Right, these are things that need to be decided before we can move forward with posting.
Oh, because I thought you just said it's been posted or it's about to be posted.
No.
I mean,
No, that we have to have this information before we can post.
Okay, and usually the committee would look at the job description as well. I
Mhm.
guess and I guess the legislature would have to approve the
Yeah, I don't
salary
think
change.
she's saying
Okay,
that we've bypassed that. She's just saying these are issues that we need to decide before we can
Okay.
proceed.
got it.
Right, right. The job description, the benefit package, and then we need to determine maybe in a smaller group, the actual process that we're going to use. So I'm
Okay.
not sure how you want to do this,
Well,
or when do we discuss it? Or is it a discussion of the committee, or is it a discussion of designated people?
well, I should think it would be a committee discussion. Kathy, do you have any insight into this?
Not really. I'm not sure. I don't know. Leslie's at the meeting. Maybe she has some thoughts.
I was trying to raise my hands, but the thing wouldn't let me.
Sorry.
No problem. Hi, everyone. So what we ask, HR to do is go back, take a look at the job descriptions, go back, take a look at the search hunters that we could use and bring us back information where it will come back to budget, because budget and on personnel, to take a look at the job description and the suggestions that come from HR. No decision has been made yet. And so budget should be the one taking a look at all of that, bringing to the full legislature recommendation for salaries, what are the fringe benefits, and any other significant changes to the job description. Job description work is the work of the HR department.
Thank you. That makes sense. We're gonna have trouble agreeing on a salary, much less a 3-page job description.
Well, the job description is pretty basic. We've made some changes as far as making it gender neutral and making sure our diversity and values language has been included. That's what we do from on this end, but I would be more than happy to share it with you. And then we would probably need to just get some time where we're going to do this. Are we doing it in committee? Are we doing it aside as a group meeting?
Well,
I
we
just
might
should have
have it in
direction.
committee.
What's that?
Leslie, what did you say?
Rose?
No, her eyelids are moving.
Leslie, we didn't hear you.
She's muted.
You're muted. Yeah, you're still muted and she's not speaking. Okay, I mean, my suggestion would be, given the shortness of the time we have remaining and the urgency of the issues relating to the capital plan, the budget, and the ARPA funds, that we decide now to dedicate a good portion of next month's meeting to deciding these outstanding issues relating to the county administrator posting. Martha?
I would be more than happy to have a special meeting sooner than a month from now. I mean, to see a draft of all these things, and so that we can move quicker than that, I think, and including the job description, we usually see track changes and kind of.
Well, we can look at the job
Well, there's
description,
no-
sure, but
If I can finish, there's not usually, much that we add, but it's a consultation. So I guess I would, since it's already July, you said you've hired the firm. That's great.
No, we have not hired them. We've only looked at the proposals that they submitted, and based upon their pricing for what we want, we would like to contract with them, but we can't do anything until these other issues have been decided.
You mean you can't do a contract with them until we have all the other stuff ready?
Right,
I mean,
because
I understand they can't post until we have things ready.
Because when we do the contract, it also has the time where they will actually start doing their job. They're not going to be involved in the initial job description, desired characteristics, those kind of things. If I don't know if we should do an actual contract until we have all the information where we can hand it over to them and just tell them to go with an implementation date.
Okay, well, however you work it out, I'd be happy to meet next week or the week after and try to move this along.
Well, I can, I want to take the temperature of the rest of the committee. Mike?
I'm glad to do whatever you think is appropriate here. I think the sooner the better we can help get this out on the street is a good idea.
Glenn?
I agree with Mike. Let's get going, but I have all the stuff submitted to us beforehand.
Yeah, I think that we would have a meeting with an agenda packet that would include options at the very least and proposals and recommendations at best. I guess we just can't fit it.
His question.
Well, I was just going to suggest that the committee wanted a special meeting, maybe meeting prior to the expanded budget meeting at 4:30. And then maybe you would be ready to report to the legislature on the 20th.
That would be great.
Okay, we can do that, I guess, if everybody is
everybody's
agreeable.
Ready, and if Ruby would be ready too.
And when is it?
It would be at 4:30 on the 19th. Does that work for you, Ruby? Can you be
Sure.
ready with options and recommendations?
Right, I'm ready.
Okay, then at 4:30 on the 19th, we will be back here.
Okay, and I'll send all that information through Kat.
Thank you, Deborah, if I may. Thank you, Kathy, for allowing me to unmute. I don't know what happened. I could hear you all, but it wouldn't let me unmute. Deborah, I'm not going to be here, but Ruby, if I can see what you have ahead of time, I'll be able to share my comments with you all for the meeting of the 19th.
Sure.
All right. Thank you all, and especially Kathy for a good suggestion. And so Ruby, if you'll just stick around for an executive session, we will move on to the county administrator's report, which I'm sure we're all just looking forward to.
Okay.
So let's see where to start. As you know, today marks the beginning of my meetings with departments to go over each departmental budget. And Kevin has been joining me with those meetings. I reported out that Dan Nolan, our budget director, individual, will start July 26th. So he'll be starting midway through this process. And we are still in the final stages with the budget analyst candidate. Unfortunately, that has not gone as quickly as the other. I had mentioned, and I wanted to point out, and happily I may add, from what Deborah shared from my correspondence with her over the weekend, where we're at in terms of our levy goals. There was a little bit of a wire crossed with Kevin on our percentages. And so thankfully, we're at approximately 1.8% now of our 1.89% levy goal. So that is the actions that we've taken to date, including the additions of the 3 positions in HR, admin, and Department of Emergency Response, as well as some new information that we've incorporated about mandate costs, put us at about 1.8% of the 1.89%. So there's not a lot of wiggle room at this point before we hit our levy goal. And I just wanted everyone to be aware of where we stood going into these conversations. And that, what was shared via email over the weekend was in excess of our levy goal and tax cap. And we're not there yet, but I just wanted to. We have a clarify. whole 0.09% to go. I wanted to clarify that, yeah.
What's the tax cap level again?
The tax cap is 2.35. Is that final? Oh, no, sorry, that's our estimated tax cap. We don't have,
Sure.
yeah, that's
Right,
that's
okay.
our estimate.
We need New York to, okay.
So, so that's one piece of information I wanted to share. And I know, and I think it's important because there are some, I know that there's some additional considerations that we heard at GO about where we're at with our assessment department and so that will be coming our way. So there are some many decision points along the way that we need to be considering. And I just wanted everyone to have this information. And that being said, as we talked about our capital plan and the assumptions that we're trying to nail down in our capital plan, that's why it feels really important, more important than ever for me this year to be able to solidify that to move forward, because we're under-resourced right now in terms of the budget preparation with Kevin and bringing someone new on. And so that leads to wanting to go over the capital plan at this week's F&I committee, so everyone is aware of the projects that we have lined up, and the request for clear guidance from this committee and the legislature as to what percentage, if any, but what percentages can be utilized through the ARP funds. And to state that as we had discussed previous with some of the different modeling and the 16.8 versus 8 versus 0% investment of ARP funds will in turn free up more or less money in our operating budget. So that in part is why I'm really strongly recommending that the legislature provide me with the guidance necessary to close this up, to go forward with, as I go forward with departments in the operating budget. The other piece of it too is that in order for us moving forward with some of these projects in the nearer term, we need to make decisions about what we're going out to bond for. And by prolonging these decisions, we are we're prolonging that process, or we're having to go down parallel tracks of, well, we could be using ARP funds or we could be bonding, and it's twice the work. So that prompted then the resolution, which is a starting point or a frame and an outline for the legislature to consider what number or percentage of ARP funds they would like to dedicate to the capital program.
Thank you, Lisa. Martha, I see your hand, but I want to say a couple of things first. Martha and I had an extended conversation this morning. Apparently she needs to be on the phone while she's on the road, but
I wasn't driving.
Oh, but anyway, she raised some questions about this. For one thing,
you know, from what pool of money are we going to be funds for cash for capital and for special projects that meet community needs, like supporting childcare or broadband infrastructure? And one of the questions we had is, you know, from the point of view of future budgeting and debt service payment reduction, it doesn't matter a great deal whether those funds come from ARPA or from our fund balance. Now, there are other issues that arise depending on which path we choose, but that's the first issue we need to consider. And I sent that question to Lisa and Rick, and I would assume the answer is that within the narrow terms of that question, it makes no difference at all. Is that correct?
My take on it, within the narrow terms of the funding itself, no. In terms of the reporting that would be required, there are some differences, and there would be reporting on either end.
Right. And then the other question that Martha and I discussed that I sent to Lisa and Rick and Jonathan in advance of this meeting is, are there mechanisms in place that would allow us to avoid violating the gifting prohibitions in order to support projects like childcare development and broadband infrastructure from county funds, from the fund balance? So I think the person who's best positioned to answer that question might be Jonathan. Jonathan, do you have any sage advice for us?
We're not sage advice, no. I mean, you know, the question is really too general. We have to be more specific than that. I mean, you know, certain ways of funding may not involve a gift provision or anything at all. You know, for example, in broadband, you know, the question is really like, well, how would you fund it? And does the county have authority to do that? May not raise any gift provision at all. But you really, I mean, we really need to be more specific about what we want to do, how we want to spend the money, who the money goes to. I mean, we contract all the time with vendors to do things. Those aren't gifts. It's when you're giving money to somebody not getting anything in return that you have a gift problem. So, you know, we'd have to look at specific plans, but for the most part, what's that?
There are ways, right?
Yeah, I mean, for the most part, we ought to be able to do things in all those areas without giving gifts.
Okay. Well, that gives me sufficient comfort, I think. And then I guess the last question, which is more a question that I had, is I'm looking ahead down the road, and I know that we're anticipating a change to our fund balance policy that's going to increase our fund balance requirements from 10% to 18%. And as Martha pointed out, we're probably not going to be flipping the switch on that all in one swell swoop. So is it your plan, Rick and Lisa, to phase that in, say, over 3 years? You're not planning to go from 10% to 18% in 1 year, are you?
We really hadn't gotten that far. We have a draft policy written that I think was last updated November 9th. Jason and I, because of COVID, different things coming up on the front burner, did not bring that to you to increase it. We never spoke of phasing it in. We were always going to do it all at one time. This is the first I heard of a phased in approach. And I mean, we're open to suggestions. We haven't passed a resolution yet, but usually when you pass a resolution that's as simple as the one that we've crafted, it's pretty cut and dry. We'd have to, you know, tear it apart and find out if there would be a glide path or a phased in approach. How would we do that? But
well, I mean, you could increase.
I know about it. It's kind of on the back burner right now. It wasn't going to come forward anytime real soon, but I wanted to let you know that the draft policy has already been written. About the that was left to fill in was, what do we do if we go way over? What do we do if we go way under? I wanted some mechanisms in there that showed how the legislature should act or react and, on either side of the fund balance. You know, if we fell below a certain amount or went above a certain amount, that there were certain dictates in there that showed you how to operate and what should be done. And that's where it kind of got stalled out. We had some ideas written down, but we never brought that back to you.
Right, and I'm concerned that we need to include in our overall planning whatever process we may be about to embark on with respect to our fund balance, because if we can glide into it, as Martha suggested this morning, maybe 12% in the first year, 15% in the second year, 18% in the third year, that would give us a little more leeway to meet the current slate of needs out of fund balance as well as ARPA. So, a draft resolution is and a draft policy are subject to revision. So just be aware that we may want to consider that. And that said, I guess Martha's just wiggling over here, so I'm going to let her ask some questions.
Yeah, we only had one conversation about it at BCP last year when I was chair. And we looked at the existing policy and just kind of got a few questions on the table and never got back to it. So, it's sort of an aspiration at this point. It's not actually a policy that we've decided the number 18% was not really voted on or anything either.
18% is the minimum that the GFOA recommends. And the basis of that is they recommend that we have 2 months worth of expenditures available for a crisis.
Okay, so I was on this thread where with Rick and Lisa, et cetera, this morning. And just to be clear, Rick sent out the unassigned fund balance numbers for 2019 and 2020, and the percentage of our, of operations. For 2019, we actually hit 24.4% the unassigned fund balance was 24.4%. For 2020, it was 27.6% was our actual fund balance. And then to turn that around to what does that mean? How much is extra? If for the end of 2020, we were $16.7 million higher than an 18% fund balance. Yeah. So we have this one-time money, 16.7 million. That is, even if right now you wanted to institute an 18%. So I just wanted to say that. So the line I'm thinking about this really comes from Jason from the budget retreat, and I don't suppose I can share my screen anyway, but that's okay. If you remember, there were 2 slides that Jason presented for sponsored agencies. Glenn can see it. Okay, sponsored agencies and also for the tourism budget, where he wanted to increase both of those pots of, both those expenditures, knowing that they are both eventually, that they're ongoing funds, but we have a gap to fill until we can build back. And he used a combination of ARPA and fund balance, and it was sort of
a glide path,
but that he sort of arbitrarily picked a number from ARPA and a number from fund balance. So what you said, Lisa, about that from the point of view of saving future ongoing costs, it's irrelevant whether it's fund balance or ARPA, because they're both one-time money.
Well, Are you asking me this question?
Yeah, I mean, it's my
Because
sense that
if we're spending it toward our capital program, toward our obligations that we're already going to fund, then it will reduce that amount in the debt service in a different way than the one-time funds toward tourism and the agencies and parks.
Yeah, I'm just using that as an example of how fund balance and ARPA are kind of interchangeable.
Yeah,
no.
yeah.
So
So I
now you
agree.
can forget that that piece of this. So what I was trying to say is that we have two sources of funding to buy our cash for capital. I mean, we're really in a very fortunate position. I mean, if there were no ARPA and we had almost 17 million above an 18% fund balance, we might say, hey, this is a great time to just do this. So that gives me a lot more confidence to say, okay, let's pretend if we just had ARPA, then it would feel like we would have a much tougher job to think about the trade-offs. Okay, we have to do this. We can only do it with ARPA. Then that's a real trade-off. You can't do something else. But it seems to me now, looking at these numbers, we have a much bigger pot to pull from. So it makes me more confident to say, because of the reporting requirements, ARPA can be used for cash for capital if people are willing to spend fund balance on things like childcare or broadband as much as Jonathan will permit us to do. So if I'm right about that, I think that's a strategy, and that certainly allows me to think more generously about cash for capital. Okay, so we can kind of get two birds with one stone. I mean, this is an amazing, where we are with the fund balance is an opportunity that's almost as big as ARPA.
Lisa? Yes, I agree. I'm storing up my comments from a few rounds, so I'll try to hit them all. So the fund balance policy, my understanding was we were considering a range with 18% at the low end, but I think it was 18 to 22 or 18 to 24. So that, and just in terms of our policy process, ultimately we put in the recommendations, but it goes through GO and ultimately the legislature to make the determination of how to implement. So a glide path certainly would be something to consider. I think, the recommendation, we would probably start out with the GFOA recommended minimum, but ultimately it's your decision. In terms of the 16.7 million fund balance, or the remainder to use with the 18%. So that was calculated using the actual revenue for 2020 and subtracting the difference of the fund balance, the unassigned fund balance account. The 2021 the 2021 estimated revenue is 195 million versus the 173.7. So, which is a more normal year. So if you took that and did the math, it's more like 12.89, 13 million in terms of revenue that we'd have. So
you're saying the denominator changes.
It's a subtraction.
In other words, the percent of fund balance is how much is in the fund balance as a percent. The denominator is the total budget.
Correct.
In 2020, it was 173 million.
It's going up 20 million. Yeah. So, I mean, 2020 was a particularly bad year. So if we lowball the revenues And then we do the subtraction based on that amount from, what we've got now. We may be out of compliance with our own fund balance policy, depending on where we set it for the coming year. That's all. I just wanted to make you aware of that.
So another point about that is that for the 2022 budget, we have 10 million now in ARPA. We don't have 20 million in ARPA.
That's correct.
So we can only tell you to use up to 10 million in ARPA.
Well, yes, but if we factor in, the capital program spans 5 years. So if we factor in future years, we can go above that, but we would certainly need to only spend for the coming year up to the 9 million mark.
Okay, so 16.87 is, more generous if we had passed the policy, which we haven't. So we're all talking orders of magnitude here.
Yep.
And to talk about nickel and diming when we're talking about millions is kind of funny, but I hear what you're saying. And I guess I'm kind of saying that I really want to use the fund balance, not just let it sit there, because I think we could do both.
I agree.
Well, yeah, I mean, if we have excess fund balance, there's certainly no reason not to use some of it. I would consider it really irresponsible to say, okay, let's spend $16 million of fund balance, because we don't know what we're going to be facing in the coming years. But I do agree, if we're concerned about providing $3 or $4 million for childcare, and we can do that out of fund balance without upsetting the use of ARPA funds for county operations, including a substantial investment in cash for capital, that's something we should do. I mean, I think the thing I want to impress this committee with is the fact that you will see, Kathy will be distributing our agenda packet for next Monday's expanded budget committee meeting. I collated everybody's vision statements. It's going to be like herding cats. We need to be the leaders in this process, the people on this committee. It would be so helpful if we could all agree on how much we want to dedicate to cash for capital, to give Lisa and Rick some clarity on this particular piece of the budget planning. So, I'd like to hear from Mike and Glenn on this as well, because obviously you've heard plenty from me and Martha. So who wants to start? Mike.
I don't think we should today try to determine what our fund balance policy revisions are going to be.
No, that's not what I mean.
Let me start with that. As far as, what Lisa has brought to us, I think I can only speak for myself on the legislature, but I have a feeling, pretty good feeling of this legislature right now. And I think we're all on the same train. And I think we're going in the same direction when it comes to things like the use of the ARPA money predominantly for capital projects. And I think we all have fundamental interests in things like childcare and other things, whether it's broadband or whether it's improving our roads, for example. But I'm glad we're going to be tackling this. I may only be able to be part of that meeting for the EBC meeting, because I have another meeting that's a quarterly meeting that's been scheduled. I may have to be only there for an hour, but I'll be there.
Okay.
But just before I give up the mic here, I just want to say that, Lisa, you're doing just what we want you to do. You are in a difficult position, and I think we understand it. We understand that it's a moving target for you, and we've got to help you, but we don't expect anybody to be perfect when we're going through difficult times like this. We only expect people to do their best and try to bring together the figures that make the most sense. And if we get off the track at some point, we'll get back on it. I think this legislature is working together on this issue. That's my feeling.
Oh, thank you for that, Mike. We may all be on the same train, but some of us are in the engine and some of us are in the caboose.
They don't have cabooses anymore.
Okay, Glenn.
I agree with Mike 100% that we should take it slowly and find out. For next meeting, we should make decisions.
Okay, well, I think we're going to try to reach consensus at next Monday's meeting. I hope we can do that, at least on the limited point of cash for capital, so that Rick and Lisa can move forward on the capital plan. Martha?
Were you looking, first let me say, Lisa, this is, you really already brought us really important information. And this is, and I'm looking back at the budget retreat PowerPoint. I mean, we knew there were beyond maintenance of effort costs that were known in April. And, everybody said, well, we'd rather set the target low, so we'll see a lot of OTRs. So that's what's happening. So this is not a surprise, and it shouldn't feel like a lot of angst. So, if we cut 47 positions last year, we put a couple of them back. Also, no big surprises here, and we're going to find a few more holes. So thank you very much. I'm sorry it took the weekend, but I understand sometimes you just really got to, it feels better to get it done. So thank you. Deborah, are you looking for us to come out with a number?
Well, I was hoping we would get to that, but we're kind of butting up against the end of our meeting. And I also wanted to say to Ruby, could you just, rather than us having an executive session, could you send the committee members an email with the information with respect to that other search? And then we'll figure out how and when we can deal with it, because we're going to be running up against the end of our allotted time. And ordinarily we can stay a little longer, but I know too that Kathy has another meeting she has to get ready for at 5:30.
Okay, regarding airport search?
Yes.
Okay.
Thank you. I'm sorry to have made you sit through this.
Oh, no problem.
Okay.
Okay.
Yeah, I mean, I was hoping that we could agree among ourselves on a number for cash for capital, that we could go into the expanded budget committee meeting with some consensus around that. But if you all don't feel that you can do that at this point, that's the way it goes.
So, I mean, I would agree with Mike and Glenn about capital projects, but they're not all within the county's capital plan. The things that I was looking at, it's not, I mean, yeah, they're all capital, but they're not like childcare centers aren't.
No, but that's not included in the cash for capital.
Right, I know.
You all will see in the document that I sent you with the relevant excerpts from the compliance guidelines that Treasury makes a really significant distinction between what kind of programmatic data you have to report on for projects that are not county projects.
Right, I understand.
So if we could do that type of project out of fund balance, we would have the best of both worlds. We would have the cash for capital from ARPA for the county. We would have the limited compliance requirements because it would be coming from ARPA, and we would not have the ARPA compliance requirements for, say, childcare or broadband, because we would be taking out of fund balance. So, Mike?
It's your microphone.
Here. I'm sorry, start your conversation off here. And I said this to Lisa, I certainly am in favor of replacing the ARPA money for using it for our revenue losses. After that, the equivalent, I would like to see 75% used for capital projects and 25% used for other things.
So that brings us pretty close to your 16.8. Glenn, do you have?
That'd be great if we could do
Okay.
that.
So that's basically three of us that are more or less in agreement. Martha?
Well, I'd agree with that to come from ARPA. If we can stipulate that proposals that we solicit through HHS or HED or whatever committees could be sort of ARPA type, whatever, is that a phrase?
Could come out of fund
Could come
balance.
out of fund balance. I don't want to stipulate, I don't want to agree to that kind of money from ARPA without people's
Commitment to the
committing.
larger community projects.
committing to
yes.
community projects out of the fund balance.
That's understood.
Okay.
And I think the next task that the expanded budget committee would probably have, and maybe that discussion would start in this committee, is that once we allocate the ARPA funds for revenue replacement, how much of fund balance do we want to allocate for, HHS or HED uses? And I think I've explained in the emails that I've sent and in conversations I've had that my understanding of the best process for those funds that would be going out to community uses would be for some sort of application and evaluation process that would go through the relevant program committee before it comes to BCP, because that's where the expertise lies in determining what's the best use of these funds. So that's where we are.
So you're looking at 75% for county projects in both years, sort of looking at the whole thing together?
Yeah.
Okay.
Because it's a 5-year plan, so we could
Yeah.
certainly include next year's ARPA funds, unless the federal government defaults on that, in which case we got bigger problems than our capital plan. Okay. Is there anything else? Am I missing anything on the agenda? I don't think so. Does anybody have anything else? Or are we done for today? Mike?
Wanted to say to Ruby, Ruby, I didn't mean to blindside you on anything today. My apologies. I just didn't realize that was coming to the committee, that report today. And that's not your fault. I didn't know that.
No, it was just a general update on the searches that we're doing. That's fine.
I understand that, yeah.
That's fine.
Okay. And then the other piece I had for anyone who's still, any of our colleagues who are still watching is, and for the people here who are not on F&I, is that Lisa will be presenting some information about the capital plan at F&I this.
Yes, we'll be adding that to our agenda.
Yeah, this Thursday at 9 a.m. If you can tune in, it would be information that you can use. And if not, I guess it'll be on YouTube. So thank you all. We're adjourned.
Yeah,